This is the Harness Money Report, a show designed to help anyone become a better investor. Every week, your host will break down a stock from beginning to end, the management, products, revenue, future, and so much more, all leading to the final stock verdict. Are you a bull or are you a bear? This show is for information and education only. Please do your own research before making any financial decisions. Thank you for being here, and now here is your host, Colin. Welcome to Harness Money. I am Colin, and today I am going to do a full breakdown of the stock Allstate. Really excited for the show today because this is an older company. It has been around for decades and it has been able to stay and grow and be successful. So I definitely wanted to jump into this company and figure out what has made this company successful and possibly what will make it successful into the future. So let's dive right into part one, the business. And the ticker symbol for Allstate is ALL. It is listed on the New York Stock Exchange. And right now, the stock price is about $159 per share. They are headquartered in Northbrook, Illinois. So I'm assuming that's near Chicago. They are an insurance business. They were incorporated in 1931. So right after or shortly after the Great Depression. And it is an old company. So 90 plus years. They've been around for 90 plus years. They will almost be around 100 years come the 30s, the 2030s. And so they are an American insurance business offering a variety of insurance products. Today it includes home, life, vehicle, and an array of other types of insurance, niche insurance markets. So it's very interesting. This one was born out of the Sears Roebuck company in 1993. So that was when it was actually spun off. But let's dig into some of the history of this business. So right now, they have about 53,200 employees. So a good number of employees. Not the most I've ever seen, but that is quite a good size workforce. And they provide products nationwide around the United States. So I can see why, and they've been around 90 plus years, so I can see why they have so many employees. That is probably one of their moats that they have, is that they have enough employees to service a bunch of different markets that are out there. So how does this company make money? Well, they make money by providing insurance to just everyday consumers. And there are a few different parts of insurance that creates revenue for a business. So this is definitely something that I wanted to explore to figure out what is the model for insurances to make money. Well, they make money by doing what's called underwriting policies. So essentially, they provide an insurance policy to a consumer, and then they collect a premium from that policy as they are writing the policy for the consumer. Now, the question comes in, how do they make sure that they make a profit? And that is through risk assessment. So that's where actuarial science comes into play. Essentially, how much should they charge for an insurance policy so that they can get a premium and make it worthwhile to write that type of insurance? And that is really a science. There is a lot that goes into the premiums and the policies and the prices and everything behind that. So that's really the art form, and that something that an insurance company really has to nail is being able to successfully underwrite their policies in order to collect that premium and to make their money. So that is one, getting the premium. The second piece is the investment income. So once you write a bunch of policies and you have this premium, then you still have an obligation to the policy holder. You may have to pay out from the insurance policy in the future, but in between that period from when you write the policy to when you have to pay out, you have a float. You have a portion of money that can then be invested into different investment vehicles, primarily bonds, treasury bonds. So if you have 1 million policies and there's a premium there, that provides some money for the insurance company to invest into the stock market, into bonds, treasuries, whatever they deem fit, and then they get the profits from those investments. So investment income is a huge a huge section of the revenue. And that's one of the things that has made Warren Buffett so successful with Berkshire. I feel like I talk about him almost on every episode because I don't know, he owns so many different businesses. There's a lot of different legs or different vehicles that he's into, and you can always learn something from looking at these investors. So insurance companies are very attractive because they have that float. They have that extra money that they can invest into the market besides just providing their products to their consumers. So what's the last part? The last part is, of course, fees and charges. So they write a policy, they take the premium, but there's also plenty of fees that go along with writing that policy, whether it be administrative fees, policy fees, renewal fees, service charges, everything that goes into the fees and charges section. Now, another way that they can mitigate the risk is through reinsurance. So basically, insurance companies, when they write a policy, they can take insurance on the back end. So they're basically insuring themselves if there is a disaster, if they have to pay out. They don't actually have to pay out all of their funds. I mean, they do initially, but then they will get reimbursed from reinsurance companies. So they can also sell reinsurance. So generally they're two separate companies, but they can do both. Some of them do both, but that is one way that this business can mitigate their risk. All right. I always like to ask the question, who is the target customer for this business? Well, the target customer is pretty much any consumer that needs insurance, whether that's a young person, middle-aged, or older person. If they need an insurance product like auto insurance or life insurance or homeowners insurance, then Allstate is for them. The one part of insurance that I don't think that they provide is health insurance. Generally, health insurance companies are their own animal, that's their own line of business, but everything else that they can practically insure for, they will do it. So pretty much the average everyday consumer, I'm sure their target is really people with families, homeowners, although they do have renters insurance, but a homeowner with that's married, that might have children, that is probably their perfect target customer. Maybe someone that lives in the suburbs with kids that are growing or young, that are going to school, that might go to college. That is probably their perfect target customer because they have a lot of insurance needs as they are growing and developing their family. So let's talk about the history. Let's really dive into the history of this business. So it was founded in 1931 at the height of the Great Depression as part of the Sears organization. So the Sears organization is really a storied American company, or it was, because it was so important at one point in time. It was one of the biggest retailers in the nation, and then it had, its demise at the time. But basically, their primary way of delivering their products to customers, or one of the biggest ways, was through their catalog. So, they were really Amazon before Amazon existed. You would receive the catalog, you would browse your products, you'd order them, then they would come in the mail a certain time later. But it was in 1925 that first Sears launched their own brand of tires, that they were going to get into the automotive space. So they offered their own brand of tires called Allstate, and then they branched out from there, providing auto services within their local stores. But as that was successful, they launched that, it was successful. It was a man named Carl L. Odell, who was an insurance broker, that recommended to the Sears chairman, Robert E. Wood, that Sears should start selling auto insurance to their customers through their mailing catalog, that it is natural progression from their actual tire business and their auto servicing business to start providing insurance to the Sears customers. And so they did. They started doing that, and it really started taking off. People started ordering it. And then in the 1950s, so around 20 years later, the majority of states passed the auto financial responsibility laws, which essentially mandated that Americans have auto insurance. So it was successful from the beginning, but it was really in the 1950s when the Allstate brand really took off and just became an essential part of American life. Is that if you had a car, you essentially had to have auto insurance. And then they also created in the 50s was their slogan, "You're in good hands with Allstate." So that was very successful. I feel like with insurance companies, they're very good at particularly creating something funny, having good slogans, something that's going to stick in your mind, whether that's the Geico Gecko or Liberty Mutual or Allstate. They all seem to have a primary advertising slogan or image that really sticks in your mind, and they really push that hard and make sure that everybody is aware of that brand. It has really helped their brand along the way. So it was in 1957 that they also began offering home insurance and life insurance. And then actually, I found this really interesting. In 1952, Allstate produced a car. They produced an entire vehicle that was sold to the public, but it actually flopped and was pulled from stores in 1953. I had no idea that Sears or Allstate, because at this time, all the way up until the 90s, Sears and Allstate were one and the same. They were a part of the same organization. So I had no idea that they tried to launch a car and that it didn't work. And they quickly abandoned that. And they tried several different things before finally becoming primarily insurance only in the mid 70s. So they did insurance, tires, and car batteries all the way up until the mid 70s when they finally just went straight into the insurance business. So when did the company go public? The business finally went public in 1993 on the New York Stock Exchange, and it was IPO'd at $27 per share, which valued the business around $8.4 billion. So Sears, the consumer retail brand, was really trying to get as much value out of this brand as possible by allowing them to go public. I'm sure that raised funds for Sears and just let them focus on their core business of selling products to consumers. I think where they missed the boat, what would have really been good for Sears is that if they had created an Allstate shop, an Allstate branch in every single store around the country. If Sears had really focused on making their stores a destination for their shoppers and had put an Allstate in every single Sears department store around the country, I think that would have made it really, really valuable. And just more of a destination where you come in, you can do multiple things. I really think that's what Walmart has done a great job of, is you can go into a Walmart and you can do banking, you can go to the outdoor section, you can buy clothing, and you can buy all your food and your essential items. They've really tried to make it a destination where consumers come back to over and over again. Where I feel like Sears really somewhat missed the boat, missed their opportunity with that. They didn't provide groceries. They really provided essentially like clothing and fashion items that just weren't really that in demand, that were cyclical, items that were cyclical. And they had some other items that were didn't quite gel well together. They did appliances, they did tools, but then they also did women's fashion. So some very different items. They were valuable. Probably the parts were valuable, but it just didn't work out in the long run for Sears. So luckily for Sears, Allstate became its own. They spun it off. It became its own business, and they did their IPO, and it was successful. So ever since then, it's done very well. So in 1996, Allstate launched their website. And they also unveiled a new business model that created a single contract for exclusive independent agents selling Allstate insurance. So independent agents, that becomes big because that is what allowed agents to really go out around the entire nation and sell in their local community. So agents could set up a shop, could be a part of the Allstate brand, get that name recognition, but then they could also be somewhat their own boss and determine their own destiny with the business. So, and that also gives motivation to the workforce to really go out there and sell. because it was their own shingle that they put up under the Allstate brand. So it was in 2003 that actor Dennis Haysbert became the Allstate spokesman using the tagline, "That's Allstate stand." And then in 2010, actor Dean Winters, which is probably what most people know today as Mayhem. And then this is a direct quote: "They're personifying the pitfalls like collisions and store damage that can befall drivers." So a lot of people know those images or those commercials with the Mayhem character, and it's all leading up to Allstate. So still doing the commercials for this business, and I've seen him in other shows and movies and things like that. So I think he'll be around for a good long time. So it was in May 2011 that Allstate announced that it was purchasing e-surance and rate comparison site Answer Financial for about $1 billion. So I would say in the last 2 decades, they have really been focused on building up their website presence, and just trying to capture as many consumers as possible through the internet, through the online and web. And I feel like they did that. They purchased eSurance and some of these online to really compete against their other competitors, because that's part of the downfall of insurance. I don't know if it's a downfall, it's just less of a moat, is that there are some very well-financed big competitors that they need to stay up with, so that they are always going to be competing with some big well-financed players in the insurance field. But it is lucrative, so I think there's definitely space for more than one business. So they really, in the past 10 years, in 2017, they acquired Square Trade, a consumer electronics and appliance protection plan provider. So I feel like in the past, they've really focused on developing their online presence, but also expanding into new lines of business. So what could the future of this business look like? It's really those two key segments, which is more online tools, maybe make AI making their business better, being better at underwriting, reaching local communities, reaching as many people as possible, and also ensuring as many lines of business as possible, whether that's technology products, appliances, boats, RVs, ATVs, motorcycles, vehicles, as many things that they can insure as possible. So those niche markets, just pushing into as many lines of insurance as they can within reason, and then just reaching as many customers as possible in the United States and Canada. So they're really primarily only a US-based company. They have a little bit of business outside the US, but they are not by any means a global player in the insurance business. So that is the history. Let's talk about the products and services. So we already pretty much talked about it. A full list here: homeowners insurance, renters, car, motorcycle, term life, boat, business, personal identity, phone, retirement. They do offer health insurance, pet insurance, travel, jewelry, collectibles insurance, and others. So they have not been afraid to make acquisitions when they make sense. So they haven't gone crazy making acquisitions. I want to say the largest that they've ever made was in 2020. They bought National General Holdings, and that was for $4 billion. And they did specialty personal lines of insurance. So that was really to expand the offering of their lines of service. So they just got access to more consumers, more niche consumers. But I would say the home, auto, and life insurance are their bread and butter. That is what brings in the lion's share of their income. Let's talk about the management. The chief executive officer is Tom Wilson for 2007. So he has been there a long time. He joined in 1995. So he has been there over 20 years and is still the CEO of this business. So I like it. I like that they have a brand that is recognizable, that they're not trying to reinvent the wheel. They're not trying to change the landscape of any particular business. They're just focused on doing the best that they can, reaching as many customers as possible. So What about his compensation? So in 2023, he made a total compensation of 16.4 million, and 12.8 of that was in equity. So a good amount of compensation is in stock. So I feel like that gives him a good motivation to grow the company, stay with the company. In 2022, $15 million total compensation package. So again, that seems pretty in line with the size of this business. It is a good size business. So I'm not surprised that the CEO makes a good, healthy amount of money. But I do kind of like to see the mix of cash and equity. Probably would like to see more cash than equity with this particular business, or just businesses in general. I like to see that the CEOs are making more in cash. I would rather see that they made more in cash rather than equity, because when they are paid in equity, that does come out of the shareholders' value. So that is diluting the existing shareholders if they are given equity in the business. So CEO salary increase over time. The salary has increased 6.2% over time. So executive vice president is a woman named Elizabeth Brady. Christine DeBase is executive vice president and the chief legal officer. And then the list goes on. So they have about, let me see here, 6 people in their C-suite. So again, for a large business like this, one that's been around for 90 years, that's actually a pretty good, pretty small C-suites, or just not an overly stuffed C-suite. That is always kind of a red flag. If there's too many people at the top of the organization, that tells me that they're not using their resources efficiently enough, and that it just means there's a lot of voices in the room, and there's not as much clarity of vision. Board of directors. The chairman of the board is Tom Wilson, so the CEO is the chairman of the board. So I like to see that he's guiding the board and giving direction, and they have about 11 directors, so not a crazy huge board of directors. And the total compensation for the board that I could find was $3,500,000. So not too bad. I mean, they're not going crazy with compensating people on the board. So I trust that those people are guiding the business in a well maintained manner. So the industry that we already talked about is the insurance, the consumer insurance industry. Competition. Let's talk about competition, because there is a lot of competition for this business. There's a lot of direct competition, but there's also some indirect competition that we can talk about. So direct competitors are the large, well-financed insurance companies that we have already mentioned, but I have them listed right here, and that is Geico, Progressive, State Farm, Farmers Insurance, Liberty Mutual, and Travelers Insurance. And I probably missed some other that are that compete with the business as well, but those are the big, well-financed ones that are direct competitors to this particular business. So those people also have jingles, have great brands, are spending a lot on advertising. So definitely competition that they have to directly compete with, and make sure that they are on the cutting edge to make sure that this business is doing well and thriving as much as any other. Indirect competition is regional carriers, smaller regional insurance companies that compete in more specific markets, like maybe specific states, or for a specific segment of individuals, like retirees or maybe new parents or something like that. So regional characters, direct online insurers, which are usually cheaper because Allstate has agents and is a little bit more full service, has a little bit more robust customer service and things like that. They are directly competing with online insurance companies that may not have as much infrastructure, but can offer policies at a cheaper rate because they don't have the overhead that Allstate has. And then captive insurance companies, which are large corporations that choose to form their own captive insurance companies. So essentially, creating an insurance company to insure their own workforce is a competition for this business. So what about their moat? Do they have a moat? And really, what I could find for the moat of this particular business is, number one, the brand recognition and history. So just the fact that it's been around for 90 years and it continues to grow and be successful tells me that they probably are going to be successful in the next 20 years, 30 years, 40 years. So really just the history and the legacy of this business, and that they haven't messed with the branding, the goodwill that they have built with their consumers. So next one is their agent network. So that independent network that they have created, those 53,000 employees, that really is a good moat for this particular business, because you don't just throw up a network like that overnight. Insurance is a regulated business, so you need a trained, capable workforce to actually execute on this type of business. So again, that doesn't just happen overnight. You really have to train your people, make sure they have everything, all the paperwork, and that they know how to operate a business. So I think that's a pretty good moat for this particular business. The indirect moat is really the data that they are collecting. How are they doing with the data and just providing customer service? Is their data making the business more efficient over time? Customer satisfaction, the wide variety of products and services. So essentially, basically all the different lines. You could go to Allstate and get many different insurance services rather than just one single service and trying to piece them all together. That could be indirect, as well as just their underwriting skills. So again, they've been doing this for 90 years. So I would expect that their underwriting capabilities is pretty lined out and just being well executed over time. So again, some of those things you just get by doing the business and doing it better, trying to get better and better and better over time. So let's talk about part two, the stock. Let's get to the good stuff. The stock of this business. It is an interesting one. So the ownership, who controls this business? Well, it's primarily controlled by the CEO and the board of directors, but the majority of the stock is owned by large institutions. So the stock statistics are the total number of shares outstanding is 262 million. So not too bad. I like to see a quarter of a billion shares outstanding. That's not crazy for a lot of stocks out there. I've seen much larger share counts than that, especially for a business of this size. Yearly shares issued is 900,000, so that's a little high, but I get it. They are issuing shares for the employees of the business. 79% of the float is held by institutions, so the institutional ownership is 78.9%, so almost 80% institutional ownership. And again, that makes sense because this business has been around for 90 years. So insider ownership is only 0.57%. So, I mean, the founders are long gone. It's been around for a long time. There have been several people that have run the business as the CEO. But I do like that the CEO has been there for a long period of time. But I wouldn't expect there to be a high insider ownership at this point in time for this type of stock. So the top funds that control this business, let's talk about them. Top funds holding the stock right now. Some of the players that you would expect, the VTI, the Vanguard Total Stock Market Index, has 8.2 million of the shares outstanding. Vanguard 500 is 6.6. Vanguard Midcap is 5.7 million shares. Schwab, Fidelity, the Spider 500 ETF has 3 million. iShares, Allspring, and Vanguard. So Vanguard by far is the largest owner of this stock. So if they really wanted to make some changes, they could, and they have a lot of say if they so chose to throw that weight around. But Schwab, Fidelity, Spider, iShares, all pretty common ETFs, and pretty much 500, the largest 500 companies in the United States, those ETFs, they're in that ETF. So they benefit from that. that position. So top institutions we just talked about are Vanguard, BlackRock, State Street, Schwab, T. Rowe, Gold, Capital, Wellington, Bank of New York Mellon. So pretty much your standard players. I like to look at that so that I know who are the people that could move this stock the most, and just to see the top institutions, who is really influencing the market. So you see those names, and those are people that can really sway the market one way or another with their decisions. And so number of institutions holding the stock, I was a little surprised. It's a little bit higher than I've seen for some other stocks, and it is 1,704 institutions currently holding the stock. So you could see why the share price is increasing if more and more institutions are buying shares of this stock, more in demand. Does this business pay employees in stock options and RSUs? Yes, they do. They do pay RSUs, 900,000 newly issued shares. That being said, I fully expect with this stock that the share count will go down over time, that they will be buying back more shares in the future, and that as they buy back more shares, that will increase the individual ownership of this stock, and it will slowly drive the price of this stock upwards. So right now, the market cap of this business is $41 billion. So pretty good. Not a mega cap, not a Google or an Amazon by any means, but also not a tiny company. This is a big company. I would consider this a mid-cap stock that's on their way to growing that market cap. So right now the stock price is $158 per share. They have had stock splits. The all-time high for this stock price was $175 in April 22nd, 2024. So this year, the most recent year, they have reached their all-time high, and the all-time low stock price was $11 per share, and that was in 1994. So it's been a long time. So it's gone from $11 per share all the way up to $175. So it has been a pretty good performing stock during that time. Not bad. So, and also I have a chart on my Substack, the Harness Money Substack. Go there, subscribe. I give all my show notes, my write-ups, my the ratios, charts, just my opinions. I put them all out there on the Harness Money Substack. Go check it out, subscribe. You will not be disappointed. And I include all my past write-ups on there as well. So there is a library of information that you can check out and read about and find your gems. All right, let's talk about dividends and buybacks. Does this business pay a dividend? Yes, it does. So the annual dividend is $3.68 per share, that means annually they pay out $967 million from their revenue in dividends. The dividend yield right at this moment, which this definitely fluctuates with the stock price, is 2.3%, which is very healthy. I like to see, if you're going to pay a dividend, I want it to be around that 3% range if you're going to be investing for those dividends. Anything a little bit higher gets me nervous. And then if you're investing lower, anything lower than that means that there was probably a run up in the price of the stock, and now it's not as attractive of an investment that I like to look at. So the dividend payout ratio is 77.31%. Does this business buy back stock? Yes, they do buy back stock. So they have consistently bought back 18 million shares each year. So right there, that's really what I'm looking at for the stock. So because it's an older stock, they may not be growing revenue as gangbusters or as quickly as other companies like a Google or an Amazon, but they are buying back they're paying a dividend and buying back a good number of shares. So if you bought and held this business just because of the buyback, you would receive more ownership in this business, and likely that's going to be reflected in the stock price. So definitely something to think about with this business. All right, let's talk about some numbers. Let's get into some numbers, because numbers are always where I like to look for stocks that I am hunting for, that I am trying to find. I either want to know, is the stock undervalued? Are they correctly valued? Or is it expensive? Is it an expensive stock based on revenue. And so once you start looking at the revenue, then it also gives you an idea of how this business is performing compared to others. Why is this business valued at 40 billion versus Apple's valued at a trillion or a trillion plus nowadays? So it's good to know the numbers and start looking and just getting familiar about what is what. So total revenue in 2023, the previous year, was $57 billion. In 2022, it was $51 billion. 2021 was $50 billion. And going all the way back to 2019 was $41 billion. So from 2019, $41 billion to 2023 was $57 billion. So almost $20 billion in increase in revenue in 5 years. So pretty good. That is a pretty good number. So they were even able to increase their revenue during COVID or through the COVID years. And then in 2021, they increased it 20% for from year to year. So they're definitely doing a good job of increasing that top line revenue that's coming in the door. But that doesn't tell the whole story. You have to look at net income and expenses. So one of the key indicators that I like to look at was the premiums and annuities revenue. So that's pretty much the writing of new policies. So in 2023, the premiums and annuity revenue was $52 billion. Out of the $57 billion, 52 of it came from the premiums and annuities. So you can tell that the investment income is definitely important, but not the core driver of revenue for this business. So pretty much where does the revenue come from? It's pretty much domestic, almost 100% domestic revenue for this business. Now, like I mentioned before, revenue does not tell the full story. So you have to look at expenses and net income. So they have definitely been increasing the top line revenue, but what about expenses? Expenses have definitely increased as well. So in 2023, they had expenses of $56 billion. So a total net incomes or profits in 2023 was negative $188 million. So even though they are increasing increasing revenue, their expenses are increasing as well, and that led to a negative net income. So in 2022, they had $52 billion in expenses and a net income of negative $1.2 billion. So in 2022, it was a negative $1.2 billion in net income. And again, that can also be contributed to several different factors. That tells me that maybe there was natural disaster in a particular area, tornadoes, hurricanes, floods, that made them pay out more of their balance sheet to the consumers, or maybe they made an acquisition that took down their net income. But again, for a very old company, the net income is going to be lumpy. The profits are not always going to be a direct line upward. The trend should always be up, that over the decades, for sure, they should be really ramping up that revenue. But from the year to year, it's not always going to be a perfect story for any business. So, but it's not all bad. So in 2022, they were negative 1.2 in net income. In 2021, they were positive 1.6 billion in net income. In 2020, huge positive net income of $5.5 billion in net income. So it tells me that since the net income has been going down and the expenses have been going up, that they are investing a lot back into the business, or they should be, versus paying out dividends or buying back stock. But it's not too worrisome, since total revenue is increasing, $57 billion in total revenue. And as long as that trend continues, I'm okay with some lumpy net income. It's just whenever you start seeing it quarter after quarter after quarter, that's when you should really be concerned and start asking a lot of questions and look back at your thesis and see if your thesis for this particular stock, if you've invested into it, has changed. So balance sheet is looking pretty good. Total assets of 103 billion in total assets, and total liabilities are only 85 billion in and total liabilities. So I like to see that. I never like to see the opposite, where total liabilities have outpaced total assets. Long-term debt is $7.5 billion. So not crazy with total long-term debt. Total cash is $722 million in total cash. So everything's looking pretty good on the balance sheet. Nothing crazy stands out to me. Operating cash flow is another. The cash flow statement, look at that. Just for liquidity, make sure business is staying healthy. Is they have $4.2 billion in operating cash flow. Free cash flow of $3.9 billion. So lots of cash to use for different purposes in this business. So financial ratios. Let's talk about the financial ratios. And I've got tons and tons of ratios on the Substack, the Harness Money Substack. Go there if you want to know more specific ratios. But the two that I always like to highlight are the earnings per share and the price to earnings. So I'm just going to highlight a few of them. First of all, earnings per share. It has, again, bounced around because they were negative. So 2023 was negative 1.2, 2022 was negative 5.1, but then in 2021 and 2020, it was 5.1. So for many years, it was positive, and now it has slipped into negative, again, because that net income has gone negative. So essentially, the higher the earnings per share indicates the greater value of the stock. So you want to see that number, the earnings per share, going up over time for for any business that you, or any stock that you are owning. Price to earnings, the PE ratio. So there's definitely a lot of different reasons to look at the price to earnings ratio. So if a stock is low, if it has a lower PE ratio, this could mean that the stock is undervalued. So it depends on what kind of stock you're looking for. If you're looking for stocks that are undervalued, or that the stock market may be overlooking, you want to buy in low today and ride that wave up, you may want to look for undervalued that have a lower PE ratio compared to their peers. So for 2023, again, negative, it was negative 119.5. And then in 2022, it was 1,873. So it's kind of all over the map on this one, just because the numbers are wild, are going from positive to negative with this stock. But not too concerning. It's around the same as the peers that are in this business. But if you want to know more, compare this PE ratio year after year to itself as well as the others in the market. So I think that is all the ratios that I wanted to address. Now let's get to the really good stuff, which is my verdict. Part 3 of the show is always my verdict. I like to give you the potential success, what could go wrong, and then whether or not I like this stock and would be a buyer. So right off the gate, potential success. What could go right with this business? Well, essentially, they just keep doing what they are doing. And it's been around for almost 100 years. They have millions of customers that they are servicing. So I don't see this business going away anytime soon unless something drastic happened. They just have to keep performing, keep selling those policies, keep reaching those customers, and keep putting out advertisements that people love, that are funny, that are catchy, and that can really capture people's mind share. I feel like more than half the battle for this particular industry is making sure that people know your name, that the consumers know the Geico brand, or the Allstate brand, or the Progressive brand with Flow, and just that whenever people think of insurance, they think of your business. So what really could go right is that they laser focus on their business, that they use technology, that the advancements in technology make this business more efficient, and that they can use the technology to reach customers in new ways, whether that be through a website or through an app, that they can really get technology to a great point where people can buy online and can buy as many policies as they possibly can using technology. And maybe someday down the line, they can reduce their workforce or be more efficient with the technology that they don't have to have such a large workforce servicing their clients. So that's what could go right for this business. I think they just need to keep trucking along, buying back more shares, increasing that revenue, providing more policies. Now, what could go wrong? The big question mark for this business is climate change. Climate change is definitely impacting the insurance business, or maybe not climate change, but climate disasters such as hurricanes, such as floods, just epic weather events are upending this industry. So the more that those occur, it's going to be more difficult to successfully write policies for policy holders. So they're going to have to really look at what geographic areas of the country they are in, and where they want to serve the most profitable customers that they can attract, and then really dialing in particular areas like Florida, those southeastern states that are prone to hurricanes every single year. How do you sell insurance policies to those customers successfully year after year after year and make it profitable without being wiped out by a natural disaster? Because they definitely want to be there. When a natural disaster hits, they want to take care of their customers as much as possible, because that is also the potential failure. When there is a time when the customers need this business, that they are there servicing all of their consumers, and those consumers are happy and not left frustrated dealing with this company and bad mouthing the company to everybody that they know. That's the worst case scenario, is that people start bad mouthing this company, and that spreads to as many people as possible, and then people stop buying insurance from this company because they have a bad reputation. So that I see as the biggest threat to this business and the future of this business is going forward. So what else are some things to think about that could go wrong? Competition. Always have to have an eye on the competition, because insurance is such a lucrative industry. There is a lot of well-financed competition that they have to compete with, that they may have to go into debt in order to compete with, and they need to stay up to date as much as possible, competing against those competitors as well. So if competition really started taking away more market share from Allstate, then yes, I would be worried. And then the last one is just investments. So a good portion of revenue comes from investment income. So if something were to happen to that income, then I would be worried. If for some reason that they were taking heavy losses in the investment space, then I would definitely relook at this company and start asking more questions, and again revisit that thesis of why I bought in. But the other question mark that I don't know exactly how it will affect Allstate in the long run, it'll most likely be a benefit, is AI and technology. Could these smaller insurance companies that are out there, that are online, use AI to take business away from Allstate, or just to compete on a bigger level? I don't know. Still a question mark. We're just at the beginning stages of artificial intelligence, so that is an outside factor that we don't have an answer for just yet. So my verdict: what do I think about this business and the stock? It's a solid business. I like that it's been around for 90 years, and that it will definitely continue to be successful into the future. There's a couple ways that you could look at this. This is not a growth stock by any stretch. It's not going to blow out earnings and become an Apple or a Google overnight or in the next 10 years, I don't think. But what it could be is it could be a sleeper growth stock because of those share buybacks. When companies get very aggressive and just continuing to do share buybacks year after year, that can dramatically bring the share count down, and that can dramatically increase the price of the stock over time. So if you're buying in today, number one, you're getting a dividend. Number two, they're buying back stock, and they're increasing revenue. So all of those three things combined could lead to more investors putting their money into the stock and the share price growing over time. So I don't look at it as necessarily a growth stock or even a stock that's necessarily undervalued. I just look at this as a solid stock that will steadily grow over time. So I think for me personally, you really have to ask yourself, what is your financial goal? Where are you best as an investor? Are you looking for those undervalued stocks today that could be massive tomorrow? Or are you more interested in taking advantage of growth stocks like Nvidia or Microsoft? You want those huge revenue gains. Even though the stock is those stocks are expensive, they are most likely to just continue their run into, let's say, the next 10 years. Over the next 10 years, they already have a huge head start. They are valuable, will be valuable. So you really have to know where you are as an investor and what your style is in order to make a decision about what is best for your portfolio. But I would definitely keep this one on the watch list. I am a bull on this stock. And if I had to give this a rating, I would say on a scale of 1 to 10, I would say a 6. So it's just a solid performing stock that I think will do well over time and will be a good addition to your watch list or your portfolio. So stay tuned. That is all I've got for you today. Thank you for watching. As always, I will be back next week to break down another stock. And thank you for watching. And remember, make good money choices. Till next time.